Welcome, folks. This is Tom O'Brien of TFNN. We're broadcasting live today from the beautiful Marriott Marquis, Manhattan. It's the Hard Asset Show. Our guest today, Ferdi Dippenaar. You've definitely seen Ferdi before. It's a beautiful thing. Ferdi is the CEO of Great Basin Trades in the U.S. under GBG, Canada, GBG. We happen to own Great Basin. Ferdi Dippenaar, welcome back to TFNN.
Thanks, Tom. Great to be back.
Good to see you.
Yeah.
You know,
It's been a while.
It has. We had Lou on, your CFO, the last couple times. You know, it's nice to have you back and give us an update of what's going on.
Yeah, I'd love to do that. Let's start with the Burnstone mine in South Africa.
Yes.
Big event. That's why I wasn't at the show last year when Lou stepped in. We had the official opening of the mine in the fourth quarter of last year. We officially put it into production in the first quarter of this year. We claimed commercial production as well in February. We produced our first 5,000 ounces in the first quarter, so Burnstone's up and running. The mill's up and running, the shaft's been completed. So as a project we've completed that. So the one thing we can look forward to now is, of course, production growth, quarter on quarter.
When we talk Burnstone, right, and I've known you now 10 years, and in the last 4 years, you've seen the birth of Burnstone. So that must have been dramatic, that you actually got it up, got it going, and then the first pour comes up, right?
Absolutely. Yeah, it's 4 years. You're right.
Yeah.
We started the box cut. It's a shallow mine. We're mining at about 400 meters below surface at the moment. So building a mine in 4 years in South Africa is quite a feat. But because this ore body is so shallow, of course it was easy to reach.
Yes.
The vertical shaft is just over 400 meters deep as well. Mining at 360 to 400 meters. It's a 20-year life of mine at the moment with a lot more to come. Yeah, it's exciting. I must say the last 4 years has been. We've had our frustrations. We had the power outages in South Africa. We had a delay in supply of power to the mine. You had building a major construction during 2008. So yes, we've had our frustrations, we've had our delays, but it's finally delivered.
And when we talk South Africa, of course, is that I'm sure all the mines at one point started shallow, but now they go miles down, right? Because there's so many minerals there, right?
Exactly. Yeah, well, I would think the average depth of an ounce of gold being mined in South Africa at the moment is probably nearly 3 kilometers, 2.5 to 3 kilometers deep.
That's amazing.
Yeah, and this is why our mine being so shallow. Bear in mind, it's taken us in total probably 7 years with the exploration and the building construction of the mine,
right,
before it was actually put into production. So it does take time. Can you imagine building a mine today? To mine at depths between 3 and 4 kilometers below surface, it probably must take you 8 to 10 years.
Oh, big time. Let's talk about the electricity a little. A few years ago, it seemed to be that was a big challenge, right? Now, my understanding is that those challenges are lightening up. Would that be a correct assessment? Or?
It is, but it is still tight. Bear in mind that, it's been more than 2 years since there was or were any blackouts in South Africa.
Okay.
But people still think about it as it is happening on an ongoing basis. It's not the case.
Right.
I mean, Eskom, the power supplier in South Africa, yeah, it was bad maintenance, bad planning, and we went into a phase of rolling blackouts. It was a few days, and they got everything back online again. We haven't had a blackout subsequently, but that still is one of the major risks associated with mining in South Africa. I still go to conferences where 75 to 80% of the questions I get asked is around power,
really?
The supply of power. Now, the one thing that people tend to forget is that when you realize you've got a problem, you can do something about it.
Sure.
And that's the one good thing that came out of that whole effort, was that a realization that they lacked investment in power, that maintenance was bad, their planning was bad, and they've done stuff about that now. So they've done a lot. There seems to be a fairly good reserve running at the moment.
Nice.
They are busy building 2 large coal-fired power stations as well. Yeah, we linked it to the national grid. We got a power station 20 kilometers away from us as well, so we have a second line as a backup. So, I think we've dealt with that risk right now.
Right. When the ramp up, okay, talk to me about the ramp up at Burnstone. How is this going to work?
Yeah, the ramp up, bear in mind it's our first year of real production.
Yes.
So anything I say about the ramp up is it's going to be subject to it's a new ore body getting underground, it's mechanization, it's a new mining method, but therein lies the opportunity as I see it. So the plan was to do 110,000 ounces this year, and then ramped up to in excess of 160,000 ounces next year. The 110,000 ounces, it is, the bulk of the production comes in the second half of the year, because bear in mind, what we do right now is just open up mining areas. And although we mined 5,000 ounces in the first quarter, we plan to do between 13 and 18,000 ounces in the second quarter. The bulk of the ramp up is in the second half of the year. So if all goes well, it's 110,000 ounces from Bernstein for this year. If you ask me, so what's the downside? Let's just say we get surprises in terms of rates of opening up, geology, or anything like that.
Sure.
I think a 15 or 20% either way.
Right,
right. I think it's realistic to at least factor in some risk.
Oh, absolutely.
But in some way, that's where I believe there's the opportunity as well.
So this is so cool. So when you ramp up a mine, so you get the rock down first, right? You get the rock down, right? Then it's a question of getting it out. So when you say open it up, you're opening the mine, making your backyard bigger, right?
Exactly.
Yeah, interesting.
So we're opening up the blocks to mine.
Okay.
And then that's the difficult part, because the mining is actually pretty easy. The mining gets done. Now with the vertical shaft in operation, of course, instead of trucking the ore nearly 3 kilometers up a decline out of the mine, we move it to the shaft and hoist it up 400 meters. And it's on a conveyor into the actual mill. So, fundamentally the project has changed to what it was over probably last year, when it was still development construction. Now it's a build-up to production.
Right.
And that's exciting phase in itself as well.
It's like a little puzzle, isn't it? Especially with I get the blocks now. I understand what you're saying, right?
And that's why if you have a look at the opening up, the more that you develop, the more you open up.
Right.
And it works. I mean, that's the way it is. And at this stage, we've probably had, if you think about surprises.
Yes.
I would think we've had more surprises on the upside in terms of grade. The grade's definitely slightly better than what we planned, which is always good.
Yes.
We planned the mine this year's production at $1,200 an ounce. We're getting $1,400, $1,500 an ounce,
which is
that's
great.
not a bad situation.
No, that's huge. Right.
We don't produce a lot of silver in South Africa, but still, what we need to do now is just achieve the ramp up.
Right.
And if we achieve the ramp up at a higher gold price than what we planned, capital is going to be a lot less this year, because the mine, right now the capital is associated with opening up and expanding the fleet.
Yes.
But the construction capital has been spent. I mean,
that's the mega
demands. Exactly. So the demands on treasury are not going to be that huge this year.
Right. Let's go from South Africa and go to Hollister.
Nevada.
Yeah, Nevada. That's right, Nevada. You sound like you're from Boston now.
Yeah, it's a lovely piece of real estate. It really is. It's
and you got that piece of real estate right. I remember when you did that deal. That was like, wow, why are they letting this go?
No, it's probably all about timing.
Yes.
And it's worked out well. It's going to work out even better for our shareholders. Yeah, we ran into problems with third-party milling campaigns, which, in my opinion, just wanted too much.
Right. No, I remember that. Right.
Well, the one mill we were going to use closed down, and we had a look around for alternative milling facilities. It came with terms which I just could not justify to the shareholders.
Right.
So we went out and bought the Esmeralda mill, refurbished, then optimized. I think what people don't typically realize is that for every ton of ore we bring out of the mine, on average, there's an ounce or 30. Now, if you talk metric tons, there's an ounce or 32 grams per ton of gold in a ton of rock, and there's 6 ounces per ton of silver.
That's big money.
That's big money, 200 grams per ton of silver. So, so what you've got in this ton of ore is a lot of metal.
Right.
And you need to tweak the plant to be able to extract optimally the metal through the process. Because it's unnatural to have that amount of gold and silver in a ton of ore. So we've tweaked the plant. The last quarter of 2010 was the first quarter we actually mined, milled at our own site, and just sent the carbon away for recoveries, because the facility was not able to handle the content.
Right.
You know, we had recoveries in excess
It was too
of
rich,
80%.
which is beautiful. That's a good problem to have, though.
It's a good problem to have, but what you would like is to increase your recoveries. You know, if we can increase it from 80 to 90%,
yes,
that's like a 10% increase in the price of gold.
Right, right. It's huge.
So, and that's what we've done. We've optimized the plant. We're busy with the final, hopefully final stage of the acid regeneration circuit, which means we'll be able to wash our carbon, wash the gold, the fouling, get a high metal content off the carbon and put it back into the system without having to send it away to the refinery.
Right, right.
So what we do right now is we load the carbon, we ship it to the refiner, and they just smelt out the gold.
Yes.
Where we can save probably $40 an ounce by just with installation of the circuit and having it all done on site.
Amazing.
So we're there with Hollister, and if you have a look at the grades holding up, the tons are increasing, you know, the amount of gold. I had a look at the graphs again. You know, it's quite stunning how that the production at Hollister has grown over the last 3 years.
Huge.
And this year, 110,000 ounces.
Yeah.
I'm quite comfortable with that target.
You know, when we look at the dollar price, and in your case, we look at the rand price too, it's kind of interesting that, you know, that you have a natural hedge on too, right? I mean, when you really look at what's happening in the marketplace.
Because the two have always been inverse.
Yes.
Yeah, strong dollar, price of gold, strong rand.
Right.
And the dollar moves with that. So what we've got with the two properties, so if the gold price had to weaken or the dollar strengthened significantly, you'll see the rand weakening.
You've been going like this. No, it's interesting. No, it's a good problem to have. I mean, because it smooths the whole deal out, right?
It does. So it gives you a natural hedge. In let's call South Africa not the ultimate first world country, but still has a third world currency in terms of fluctuation.
Yes.
It's still seen as part of the emerging markets, and so the stronger the dollar, the weaker the currency will
yes.
be.
Right.
So it's a nice situation to be in.
It absolutely. Well, you know, we really appreciate the update. It's pretty amazing. Now you get the full plate, though. I mean, which is so cool because, you know, you get both of them going, you get the mills going. Now it's just basically just tuning it up. And, of course, every day it gets tuned up more.
It does. No, bear in mind, 28, 27, 2008, which was the financial crisis. I mean, we're busy building, constructing mines.
Thank God.
Both
I
at
know.
Hollister and at Burnstone. Yeah, 2011 to us it's no more construction, it's now production.
Right.
So it has been a fundamental step change.
Yes.
And I think it's as soon as we consistently keep on showing that to investors, that the change has taken place, that we actually, you know, will now be adding funds to treasury instead of spending it like we have for 4 years.
Sure.
I mean, we've been spending a huge amount of capital on both our sites over the last 4 years.
Right.
And I think investors are sitting back and saying, well, as soon as we start seeing money coming back into treasury, consistency in performance, increase in production at Burnstone, we'll see that closing gap in terms of what the net asset value of the company is and what the stock price is.
Absolutely, no doubt.
And I expect to start seeing that as we go through 2011.
No doubt.
Thanks, Tom.
Well, Ferdi, thank you so much for being with us. Folks, our guest today was Ferdi Dippenaar. He's the CEO of Great Basin Gold, trades in Toronto, trades in the American Stock Exchange, New York Stock Exchange, GBG. Have a great day, have a safe day. We look forward to speaking to you again.